When considering the vast landscape of investment opportunities, bonds stand out as one of the most time-tested and reliable instruments. But what exactly are bonds? How do they work? And what makes them so beneficial for investors seeking growth, stability, and diversification? At its core, a bond is a type of loan. When you purchase a bond, you're essentially lending money to a government, municipality, or corporation. In return, the bond issuer promises to pay you regular interest payments, known as the coupon, and to repay the principal, also called the face value, when the bond reaches its maturity date. This straightforward mechanism forms the backbone of countless financial portfolios around the world. The benefits of bonds are numerous, and their appeal lies in both their structure and their role within a balanced investment strategy. One of the primary advantages of bonds is their ability to provide steady, predictable income. Unlike stocks, which can fluctuate wildly in price and may not offer any regular payments, most bonds pay interest at fixed intervals, often semi-annually or annually. This predictable stream of income can be especially attractive for retirees or anyone seeking regular cash flow to cover living expenses or to reinvest for further growth. Bonds also offer a level of capital preservation that is hard to match with other investments. When you hold a bond to maturity, you are typically repaid the full face value of the bond, assuming the issuer does not default. This makes bonds a relatively low-risk investment compared to stocks, which can lose value permanently. For conservative investors, or those nearing major financial goals, bonds can serve as a stabilizing force, helping to protect the money they've worked so hard to save. Another key benefit of bonds is diversification. By including bonds in a portfolio alongside stocks and other assets, investors can reduce overall risk. This is because bonds and stocks often react differently to economic events. For instance, when the stock market is volatile or declining, bonds may hold their value or even rise, especially government bonds like U.S. Treasuries. This negative correlation helps smooth out the ups and downs of the overall portfolio, providing a more consistent investment experience over time. Bonds also play a crucial role in managing interest rate risk and inflation. Certain types of bonds, such as those with floating interest rates or inflation-linked bonds like Treasury Inflation-Protected Securities, TIPS, can help shield investors from rising interest rates or inflation eroding the purchasing power of their income. These specialized bonds adjust their payments to reflect changing economic conditions, offering an additional layer of protection. For investors seeking social or environmental impact, bonds can serve a dual purpose. Green bonds, for example, are specifically issued to fund environmentally friendly projects. Social bonds target initiatives like affordable housing or healthcare. By investing in these types of bonds, individuals can align their portfolios with their values, supporting causes they care about while still earning a return. Understanding how bonds work is crucial to making the most of their benefits. When you buy a bond, you pay the current market price, which may be more or less than the face value, depending on factors like prevailing interest rates, the issuer's creditworthiness, and the time remaining until maturity. The interest rate you receive, known as the yield, is influenced by these factors as well. Over the life of the bond, you'll receive coupon payments according to the bond's terms. If you hold the bond to maturity, you'll get back the face value. However, you can also choose to sell the bond before it matures. The price you'll get depends on market conditions at the time. If interest rates have fallen since you bought the bond, your bond, which pays a higher coupon, may be worth more than you paid for it. If rates have risen, it could be worth less. This relationship between interest rates and bond prices is a key concept for bond investors. Credit risk is another important consideration. While government bonds are considered very safe, corporate bonds carry a higher risk, depending on the financial strength of the issuing company. Bonds are rated by agencies like Standard & Poor's and Moody's, with higher-rated bonds considered safer, though they typically offer lower yields. Lower-rated, or junk, bonds carry more risk but offer higher potential returns. By understanding these risks and balancing them within your portfolio, you can tailor your bond investments to your unique financial goals and risk tolerance. Liquidity is a further aspect to consider. Some bonds, like Treasury securities, are highly liquid and can be bought or sold easily. Others, particularly municipal or corporate bonds, may be less liquid, meaning it could be harder to sell them quickly at a fair price. Knowing the liquidity of a bond helps ensure you can access your funds when needed. Tax considerations also come into play. Interest from municipal bonds is often exempt from federal and sometimes state and local income taxes, making them especially attractive for investors in higher tax brackets. Corporate and Treasury bond interest, on the other hand, is generally taxable, so investors should factor this into their overall return calculations. Ultimately, the decision to invest in bonds comes down to your personal financial objectives. Are you seeking steady income, preservation of capital, or a way to balance the risks of your equity investments? Bonds can fulfill all these roles and more. By providing income, safety, and diversification, bonds have earned their place as a foundational component in investment portfolios of all sizes. In times of economic uncertainty or market volatility, the value of bonds becomes even more pronounced. They serve as a safe harbor, offering reassurance that your investments are working for you, even when the broader markets are turbulent. Whether you are a seasoned investor or just starting out, understanding the benefits and workings of bonds empowers you to make informed decisions that support your long-term goals. With their unique combination of features, bonds are more than just a source of income. They are a powerful tool for building and securing your financial future. Thank you for joining us today and learning more about the benefits of investing in bonds. If you found this information helpful, don't forget to hit the like button and subscribe for more insightful content. We'd love to hear your thoughts or questions, so please leave a comment below and share your experiences with bonds. And if you know someone who could benefit from this knowledge, be sure to share this video with them as well.